Ethan here from Investing Note. Thank you for joining our webinar tonight. All right. Okay, let's just give us a few minutes for people to come in. All right. Okay. How's hope everyone is doing fine. All right. Okay. So of course today we have two distinguished guests. Wong and Adrian Chiu. So Wong is actually the head of research at China Galaxy International, and of course Adrian Chiu is actually a vice president at CSOP Asset Management. Guys, you can say hi.
Chiman first.
Hey. Good evening. Thank you very much for joining this webinar. And I'm Wong Chiman, head of research of China Galaxy International. And I hope during this hour we can share the investment ideas with you.
Thank you, Chiman. Adrian here from CSOP Asset Management. Likewise, echoing Chiman's, we're here to talk about the oil economy and hope that after this 1 hour, you guys has a bit more confidence in investing into the oil economy or the value stocks after this webinar.
Okay, cool. All right. Let's just wait until more people stream in. All right. So hope everybody is doing well. Okay, it's a semi-lockdown right now. Yeah.
We're not sure when it will end,
Yeah. Seems like it's been a while for it's been a long while. Yeah. Okay, let me power up the slides. Great. Just give us a few more minutes, then we'll start. Okay, just some house rules, guys. If you have any question, please put your questions in the Q&A section, all right? Okay. Do not put it in the chat because questions put in the chat, right, will be ignored. Because, yeah, I'll only be picking the questions from the Q&A section. All right, cool. Okay, I think without further ado, good evening, everybody. This is a formal introduction. I'm Ethan from Investing Note. Good evening. Right, so today's topic of the webinar is are old economy stocks back in favor? Right, so joining us, we have two special guests, of course, two distinguished gentlemen. First is Wong Chiman, who is the head of research from China Galaxy International. And also we have Mr. Adrian Chiu, who is vice president at CSOP Asset Management, right? So Adrian and Chiman, you guys can say hi.
Evening, good
Hello.
evening. Hi.
Good evening.
Yeah, cool. Okay, let's move on to the next slide. All right. So so these are their profiles. I just introduced them, right? Okay, so Chiman is based in Hong Kong, right? He has close to 20 years of experience in this equity research industry. Right, I think we have previously worked with Chiman on a couple of webinars before, right? And of course, Mr. Adrian Chiu, he has also worked with us on a couple of webinars previously as well. So without further ado, let's dive down into the webinar, all right? Okay, before we start, these are some, disclaimers that, of course, all this content inside this presentation is, mainly for educational purposes, okay? All right, cool. Let's start. So I think right now, let's set the stage on the context, right? So I think we are in a period where we expect, with the vaccine, at least that things will get better, right? But seems to be, especially for Asia, there's been a resurgence of COVID cases, right? And if you're talking about the stock market, so there has been some interest in those long ignored value stocks such as bank stocks. Let's just take a look at DBS is at $30 of closing today. Yeah. It's close to $30. Yeah, right. So some of this sector rotation, we have called it, right, or we deem it to be, is actually, showing signs that there's rotation from the new economy to the old economy, right? For example, if you take a look at the MSCI China Bank Index, right? So it has actually outperformed the China index by, about 25 percentage points over the last 2 months. And if you take a look at, stocks like Alibaba, Tencent, so they have been, on the downtrend as compared to, those old economy stocks, right? Okay, so I think without further ado, let's start with China. So, Adrian will and Jiman, like to ask you, where are we heading in this sense? Can you share some insights on that?
Definitely. The next slide, please. Yeah. So when we look at China, we look at two bellwether indicators. We'll probably be looking at the manufacturing and the non-manufacturing PMI as well. So just take a step back. If the PMI were to come in at above 50, this means that a particular industry or sector is actually going through an expansionary kind of phase. If the index were to come in at below 50, it means that the phase is the sector is actually going through a contraction. So for 2020 last year, China was at the epicenter of the pandemic, and ever since then they actually have managed to control the pandemic situation very well. Managed to get their workforce back to working, and we say that it's actually last year was a recovery story. Beginning of this year is actually about recovery to growth, and I think going forward for second half of 2021 is about sustained growth for China. And having said that, after the COVID-19 mild disruption happening in February or during the Chinese New Year, right, where you could see that manufacturing PMI and non-manufacturing PMI dip off its high, but the Chinese government came down and clamped the COVID again very swiftly, and you could see that in April and in March the PMI reversed back up again. So the April China manufacturing PMI came in 51.4. Is still going through an expansionary phase. Recovery and sustained growth is actually uneven. The non-manufacturing sector actually recovered at much faster. Came in at 59.4 for April versus March at 56.3. So you could see that this is actually almost a year of sustained expansionary for both the manufacturing and the non-manufacturing sector. And having said that, another key point that we look at how good or how is China performing is actually looking at the unemployment figures. And having said that, the unemployment figures or unemployment rate for China is actually continuing to come down. At the high of the COVID-19 case back in February last year, the unemployment rate was actually at 6.2, and right of April this month, last month for example, came in at 5.1. So you could see that the unemployment rate is actually coming down. More and more people are going back to work already. So this part, China definitely looks very good. On the another side of the story is actually we look at the import-export, being the factory of the world. The April trade demands continue to come in double digit. So due from a low base, the April export in USD term came in at 32, about 32.3% versus 30.6% for March. And for import as well, came in at 43.1 versus March 38.1 as well. So both import exports are coming in at double digits. Exports stands out, signaling that Chinese market share has actually increased. Now, due to Chinese government clamping down the pandemic spread and getting their workforce back, they managed to gain 2% market share in terms of the global exports in that case. So during a year in 2020, when everyone is actually going through a trade deficit and going through a recession, China turned a crisis into opportunity, and came and created a trade surplus of $535 billion. So financially, the country is actually doing pretty okay as well. Can I have the next slide, please? And having said that, where we think is actually that Chinese economy continues to show a V-shaped recovery. In 2020 Q4 last year, the GDP came in at 6.9, and for the year annual GDP ended at 2.3. So it's actually exceeding the forecast of what major the major World Bank's rating as well, which is actually rating that they believe that China only have a forecast of 1.8 GDP growth, but China came in at 2.3. So that is actually beating the expectation for the world from the World Bank's kind of rating. And having said that, GDP for China last year exceeded $100 trillion for the first time. So going forward, the GDP forecast for China would, even though the government set it at 6%, but we believe that, and UBS also believe that GDP for China will come in at about 7.9, and UBS also did raise the forecast for GDP at coming at 9%. So having said that, we believe that retail sales, which take a bulk of the GDP, will come in at about 40%, which cater about 40% of the China GDP, will come in at 8% year on year for 2021. So these are some of the rosy picture. Maybe Chiman, do you have anything to add?
Yeah, I think we may go to the next slide. Yeah, I think not just the export data or PMI, if we also look at other indicators, as you can see from this chart, which is the online retail sales in China. You also see in second quarter of last year, after the COVID-19 impact in first quarter last year, starting from second quarter, we see a quite strong recovery, especially because why the online retail sales rebounded so strongly is partly because of the social distancing measures. So that's why many people did their purchases online. And so that's why if you look at other data, you may also find that like some hardware like PC or handset also see very strong performance starting from Q2 last year. And that also explains why I think some of you know that for those new economy or technology stocks in 2020, both Asia market and Hong Kong market performed quite impressive. And but at the same time, you can see maybe in very recently, after the low base effect is fading, and right now we see some slowdown in the online retail sales. And we go to the next slide. And another thing I think right now, especially I think some of you know that the Hong Kong market and the Asia market performed very well in the last 2 days, partly because of the strength of renminbi. And in fact, you can see here for some major sectors, for example, as you can see from this chart, the China Construction Bank and the renminbi exchange rate, you can see actually when usually when the renminbi exchange rate is strong, those Chinese banks' share price performance also stronger. Usually, I think to a certain extent, because when the renminbi exchange rate is strong, it partly or to a certain extent reflect the Chinese economy is relatively strong or perform quite well, and that's why we see a stronger exchange rate that reflected in the performance of the banks, given that the Chinese banks usually is also the performance usually reflecting the economic situation in China. So I think that also shows you another kind of evidence showing that right now the Chinese economy is recovering. So we may go to the next slide.
All right, I think Chiman, very good sharing, and thanks Adrian for sharing about the GDP forecast as well. So those are some stellar numbers that we can expect from China, at least for the near term, right? So let's move on to the theme of inflation, interest rate. So we know that the past at least 1 month or so, we have been expecting a lot of investors have been looking for the Fed minutes, especially when Jerome Powell and Janet Yellen has been hinting about inflation and possibly interest rates being increased, right? So for investors, for retail investors, what are the trends that we should look out for? Adrian, you're on mute.
Apologies. Now, can you guys hear me? I want to check with the audience because I'm looking through some of the Q&A. Some of the audience felt that we were speaking too soft. I just want to check again, do a mic test. Are the audience able to hear us very clearly right now?
Yes.
Okay. Got it. All right. So again, we look at some, when we talk about inflation, we look at commodities. And for example, what our house views that whenever there is inflation, the copper price would usually run faster than the oil price. And we could see that right now, the Shanghai copper price is actually has moved ahead versus the oil price at the moment. And when it comes to US inflation, when we always look at the WTI crude oil as well. And you could see that the WTI price for crude oil has actually goes up. And we expect the inflation rate to go up for US as well. Can I have the next slide, please? And having said that, when we also look at right now what China is doing, and we felt that the short-term liquidity, which is actually the orange line, which is a short-term 3-month interbank offer rate, which is actually the short-term liquidity is provided by PBOC. It's actually going through an easing phase right now, and the 10-year Treasury yield, which is actually the blue line, is actually the long-term view as well. So when it's very wide, this means that the market expectation for economic growth is very low, and if that were to narrow, this means that the reflects the market expectation of the growth of the particular country. So having said that, we felt that China right now is actually narrowing. So the market expect China to be entering a normal phase, actually past the recovery phase, actually going through a normal phase of growth right now. The next slide, please. And for US, it's actually a different picture. You could see that in terms of the short-term liquidity versus the 10-year Treasury yield right now, it's actually still very wide apart. And rightly said, so Biden has actually just, has actually approved a 1.9 trillion COVID-19 aid package for US citizens. So right now, I felt that the market expectation for economic growth for US is still very, very low. And having said that, this just came in yesterday that the inflation rate right now actually dropped about 10 basis points at the moment. And market implied US inflation expectation actually dropped the most since 2020. And you could see that actually the year actually dropped by 10 basis points. And having said that, we could see right now US equities rose. The Fed came in and said that play down the risk of persistent inflation. And based on the research report by Bank of America, Merrill Lynch, and a breakdown of inflation right now. Right now, they believe that inflation is actually very short term due to supply constraints due to the COVID-19. And due to the whole spectrum of all the sectors that's actually in the article is saying that which part of the chain is actually going through a shortage. Only 20% is actually affected by persistent long-term inflation. So we will believe that inflation right now is actually much reduced from what it was discussed probably in February earlier this year. So what do you think about Chiman about commodities going forward?
I think for commodity plays, actually it performed very well year to date. But in the near term, maybe for the next 1 or 2 months, we believe investors should be more careful because we expect to see more volatility in the near term. Because the reason why is because of the very fast increase in commodity prices in the last few months. We noticed that the China State Council, they already pay attention to this issue because it affects the downstream manufacturing sector. And that's why last week we noticed that the State Council saying that they are paying a lot of attention to the adverse impact of the increasing commodity prices. And that's why in the past few days, you see those commodity stocks quite volatile. And in fact, yesterday, the Chinese government coming out again from the NDRC, they also said that they are meeting with those major commodity companies. And they are also saying that they will try to make sure the commodity prices remain a healthy trend. So I think this kind of messages from the government may lead to higher volatility. of the commodity stocks in the near term because of potential policy risk. In particular, the State Council also mentioned that they will try to avoid or prevent the transmission of surging commodity prices to hit the CPI. So that's why I think this is the policy risk we need to pay attention in the near term. In fact, if you look at this chart, you can also see right now the PPI is increasing, but the CPI is still relatively low. But the concern is whether we will see a transmission from PPI to CPI. And we may go to the next slide. Yeah, I think this table highlights the year-to-date performance up to last week of those major commodity plays. For example, those are coal miners, steel companies, or some of the aluminum companies. You can see nearly all of them, they have very high double-digit gains or even triple-digit gains year-to-date. And that's why in the last slide, I say that in the near term, we may see more volatility because given that the policy risk is increasing, some people may just take profit first. And that's why we keep saying that for investors, if you invest in commodity plays, you may need to pay attention to the increasing volatility in the next maybe 1 or 2 months. We may go to the next slide.
All right, thank you, Chiman, for sharing. So I think commodities has definitely been a lot of buzz in that space in this last at least this last 1 month, if you can see from the chart as well. So these are actually what we call a sector rotation probably. Right. So let's move on to the next question that a lot of retail investors have on their minds and probably audiences as well. So, right now I'd like to ask both of you, right, where are the bright spots and where are the potential dark spots that, investors should look at and potentially avoid as well? Can you shed some insights on that?
In fact, if we look at this chart, you can see to a certain extent, it's a global phenomenon, as we highlighted in the head. Because last year, in particular, because many government, they launched the so-called monetary easing or QE. So the interest rate coming down, and it usually when we see a low interest rate, it is favorable to those growth stocks or so-called new economy stocks. And you can see last year, the blue line, you can see the S&P growth index performed very well. But in this year, you can see the red rectangle. After the very impressive rally last year, you can see higher volatility of the growth index because after such a huge gains last year, when we see any negative news, it's much easier to trigger profit taking. And that's why we see more volatile share price performance this year. But if you look at the white line, you can see the performance of those value stocks or old economy stocks. You can see a much more steady increase because as we explained earlier, because right now we see the general economy is recovering, and that's why we see this kind of switching from growth to value. And we may go to the next slide. And another thing we need to pay attention is, for example, if you look at the left-hand chart, you can see last year, the M2 growth of China increased quite significantly because the Chinese government tried to increase the liquidity in the market to support the economy because of the COVID-19 impact last year. But as you can see, in the last few months, the M2 growth has been coming down right now back to the 2019 level. So basically, we are seeing a normalization of the monetary policy. And that's why if you look at the right-hand side, when you look at the so-called rolling forward PE of the MSCI China Growth Index, you see a quite meaningful correction in the past few months, because last year we have a more favorable monetary policy, but this year, obviously, the monetary policy is going back to a more normal situation. And that's why, to a certain extent, you see the compression of the valuation, and that's why we see the correction of the growth stocks or those new economy stocks. And we go to the next slide. And another thing is, after the correction of those new economy or growth stocks, in fact, some of them, I will say, if you just look at the valuation, like Alibaba, Tencent, their PE already back to historical average, or Alibaba already quite below historical average. So for maybe longer term investors, there may be some opportunities there. But in the near term, I will say for investors, if their risk appetite is not that high, in the near term, I think should still be more careful. As you can see, because in the past few months, the Chinese government for the technology sector, they are talking about some policy issues, like antitrust or other policy issues. For example, like for Alibaba, they are talking about the Ant Group may need to restructure their so-called e-finance business. And that's why if you look at the latest earnings forecast, on the top is the EPS forecast of Alibaba, and the bottom one is the EPS forecast of Meituan. You can see the analysts generally is still lowering their earnings forecast. That means there may be still some downside risk or share price volatility, because the market expectations still keep lowering. So I will say, valuation-wise, some of the stocks like Alibaba, Tencent, getting back to a more reasonable level. But in the very near term, if some investors, their risk appetite is not that high, probably should still be more careful. And we go to the next slide. And that's why we will say right now, if we look at some of the so-called value stocks or old economy stocks, we believe the Chinese banks right now still deserve more attention, because actually, if you look at the Chinese real economy, for example, if we look at the NPL ratio, in fact, in Q4 last year already reached the peak level, and we see a gradual improvement in the NPL ratio. And at the same time, if we look at the right-hand side, the so-called monthly industrial profit of the Chinese companies, you can also see a very strong rebound in industrial profit. And that is also a positive to the banks, because those industrial companies, they may borrow money from the banks. And right now, if we see an improvement in the industrial profit, that means the so-called bad debt risk or NPL risk should also come down, which should be a positive to the banks. And we go to the next slide. And in fact, if we look at the so-called growth versus value from a top-down perspective, you can also see right now we try to divide the PE of the growth index by the PE of the value index. You can see even after the correction of those growth stocks, right now this ratio is still higher than the historical average. That means at the current situation, the value stocks still look relatively attractive for the MSCI China universe, and that's why right now we still believe it's not too late to look at the value stocks at this point of time. So we go to the next slide. And among the old economy sectors, one of our preferred sectors is the Chinese banks. As you can see from both charts, the left-hand side is the price to book of China Construction Bank, and the right-hand side is the price to book for ICBC. You can see even after the rebound in recent months, right now the price to book is still quite low compared with the past few years. And that's why we believe, given that the asset quality, that means the NPL ratio, is still improving, we believe there's still further upside for both CCB and ICBC, and actually the general China banking sector. And then the next slide. And if we look at the dividend yield of both companies, we can also see that right now the dividend yield is still much higher than the historical average. And given that this year we can see the market volatility is relatively high, so I think the quite decent, or actually quite high dividend yield of the Chinese banks should also offer some defensiveness to investors given the current situation. And then we go to the next. And actually, what we are trying to explain here is in the past few rally of Chinese banks, actually is more driven by the asset quality improvement rather than the earnings growth based on our study. That means people are looking at the NPL ratio. That means the bad debt ratio. Look at the trend rather than just looking at the EPS. And as we just explained, right now for the China banking sector, we see the NPL ratio already peaked in fourth quarter last year, and right now it's gradually coming down because the general economy is recovering. And so we expect in the coming 2 to 3 quarters, we expect the NPL ratio will continue to improve. And that's why we still believe the banking sector in the next few months, we should still see quite good performance going forward. So we go to the next slide. In fact, for the financial sector, not just the banks, if you look at the insurance stocks, both China Life and Ping An, based on the price to embedded value, right now, in fact, is still quite cheap compared with the last few years. Basically, it's at the low end of the range in the past few years. But relative to the banks, for the insurance stocks, I think investors may need some patience. Probably may need to wait until the second half of this year. And we'll explain more in the next slide. Because although the valuation is very cheap for the insurance stocks, but for the major insurance stocks, for example, like China Life and Ping An, we still see some company-specific issues they may need to handle first, and then in the second half, when they can really tackle the issue, then we will see a better performance of the share price. For example, for China Life, their reform of their agency team probably still takes some time. And for Ping An, actually, is a bit better, but to a certain extent, they also need to tackle some issues related to their life insurance agents. And that's why for both companies, we may need to wait until second half of this year to see a better performance, which is a bit different from the banks. So we go to the next slide. Yeah, Adrian, maybe you may also share your view with us.
Thank you, Chiman, for covering most of this portion. And I would just to echo your views on CSOP's house views as well. And like you did mention, we are going to expect a very volatile market, and I think we should look at some very low valuation kind of sectors right now. The reason is, if we look at it, is when the central government starts to tighten market liquidity, those sectors with high valuation are actually at higher risk. And having said that, Chiman pointed out that most of the banking sectors, or the most most of the old economy stocks right now are of very low valuation. Besides, offering a very attractive price to enter right now, I think right now, China looking at, going through a neutral stance, whether or erring more to the side of, tightening market liquidity, because right now the economy is doing very well. We will see a lower risk in terms of this lower valuation, and in kind of like, in sectors such as industrials and banks that are facing a more competitive advantage versus the growth stock right now. And having said that, we could see it, I mean, based on this table right now, looking through our research, like you rightly mentioned, pointed out, the industrial profits are going up, and we could see industrials, right, that they're actually, in terms of change in market share, we could see the market value actually gone up about 1% already since February. And like you also rightly mentioned, I just want to write on to what you have mentioned, is that financial is actually going to lend money to the industrial. We could see that, the market value from financial sector has also gone up by 1.55%. So all these are, just an evidence just to back up Chiman what you have mentioned, and also to reflect the house view as well. So these are some of the sectors that we think are actually of the bright spots. We definitely see some of the headwinds in terms of consumer staples, consumer discretionary, IT as well. We saw a bit of like, profit taking for in that sense. So, we believe that, China now taking the lead in terms of economic recovery and returning to normal production, and possibility of returning back to the life as usual. We should look at, the pro-cyclical sectors such with low valuations and high performance. Right now is actually very attractive to enter right now. The next slide, please. And having said that, China being first to return to growth, right? They also have coined this theory called the internal, the dual circulation, where they want to boost domestic consumption. So China right now itself as a huge domestic market with a population of 1.4 billion. It's forecast that, their middle income population will grow up to 800 million in the next 15 years. So that is itself will be a sustained growth for China domestic market already. And then comes along with the policy support, with the China Central Economic Work Conferences, emphasize more on management of the demand side. We believe that would also help, the internal consumption. And just to all this will actually, boost the retail sales that we mentioned earlier. We'll expect to grow 4 to 5% 2021. It's a bit low on the low side versus what UBS and our house view of 8% year-on-year growth for retail sales. They are more humble. They see about 4 to 5% year-on-year growth in terms of retail sales for this year alone. So we felt that, consumption is coming, and that also will actually increase a lot of spending, and that also definitely will help financial stock as well. The next slide, please. And just to say that, we also do look good. We felt that, financial stocks will still look very good. And we believe in three sectors. The leading bank, the leaders will definitely take it all. Usually, the big established companies will definitely take most of the market share. And having said that, we will definitely want to look at leading banks with strong profitability and higher PE, but also lower PE in terms of average than its peers. Healthy balance sheet, good corporate governance, mature business type. That's what we are looking for. Leading insurers, Chiman, like Chiman said, you go long haul for insurance, and usually most of our insurance agent we look at the China 10-year government bond yield, right? So the yield has picked up a little bit, and that is actually could be beneficial for insurance business going forward. And we see a mild growth. And just to echo what Chiman said, we also feel that it's going to be a mild growth for insurance company for year 2021, and brokers, because right, there's a going up, there is a reform by the Chinese government to open up their capital market. Most of the IPO is actually shifting to a registration-based kind of model. So that would actually speed up the IPO process. So I believe in terms of financial industries, right, these are the three sectors or the three subsectors within the financial industry would actually benefit, or we felt that this will actually be more tempting for us to invest into going forward. And can I have the next slide, please? And just to rightly pointed out with what Chiman says in terms of our house view, like in terms of most of the Chinese is actually assets are actually denominated in renminbi. And having said that, as when the renminbi strengthens in terms of other currencies, definitely it's actually good for the valuation of Chinese assets as well. So by looking at the China A50, right, we could see that renminbi has actually appreciate very, very strong performance against US dollars for the last a couple of months. And you could see that the FTSE China A50 index has actually also rallied as well. The next slide, please. And having said that, looking at the index right now, the index PE is actually off its high in February of this year as well. So right now, unfortunately today, the FTSE China A50 due to a price movement in terms of the renminbi in probably about in the afternoon today. So we saw a huge spike in terms of the price, and today China A50, the FTSE China A50 rally over 700 points and closed up 728 points today. That actually pushed up the average PE for the index to about 15.13, but it's still actually off the highs. I think there's still some room to go going forward, and I think what. Just to echo again, Chiman is favorable about the renminbi, which we are also favorable about renminbi as well. That will actually provide additional price support in terms of Chinese asset and to this index as well. Can I have the next slide, please? So what within this FTSE China A50 is that they is actually provide diversification into to the industrial that we are looking good at. We find that there's some bright spots in terms of industrials and also in financials. So within a single trade, you can actually buy into this index, and you can actually track two sectors, having if to just to reflect our views. And having said that, can I have the next slide, please?
Yeah, I think Adrian, just to put a point across, right? Just to ask, you guys do have a ETF which is based off the A50 index, right?
Yes, we do. Yes, we do.
Yeah, so just to let the audience know, so the ticker code is actually 2822, right?
Yep.
All right, cool. So if you're interested, just check out the index. So I think Adrian brought up a good point. Today is about 4% increase in the price of the index as well. So you guys can check it out later. Right, let's move on to the next slide.
Yep, and besides the price support from renminbi, and we believe that the good economic health of the Chinese economy right now, in terms of and that would definitely drive out in terms of capital gain. They also provide a average yield, which is forecast to about 2.2% at year end for this year in terms of dividend yield, and it's actually forecast in 2022. We will come in a dividend yield about average about 2.5% for next year as well. So we could see besides strong renminbi policy support kind of industry, economy, first to recover from the pandemic, and also capital gains, and we also believe that it provides some form of a dividend yield as well for the FTSE China A50 index.
All right. Thanks, Adrian and Chiman, for sharing this, so comprehensive. There's a lot of data about the China market, right? So, after talking about China, let's talk about Hong Kong and the Hang Seng Index, right? So, Adrian and Chiman, like to get your views on this.
In fact, as you can see here, if we look at the large cap sectors last year in Hong Kong, you can see those perform the best, like the new economy sectors, basically healthcare, hardware, technology, similar to the US market because of the favorable liquidity environment. And at the same time, last year we see, because of the switching, those old economy sectors like financial, property underperformed. But if we go to the next slide, if we look at the year-to-date performance, we see a very different picture because the so-called normalization of the monetary policy. And that's why, and in fact, the real economy is also recovering, as we mentioned earlier. And that's why we see the energy sector, the banks, Hong Kong property, all these old economy sectors perform quite well. But at the same time, we see those new economy stocks which outperform quite a lot last year, like technology, hardware, and also auto, because of the new energy vehicle concept. We see profit taking in the past few months. And we go to the next. And maybe I will also let Adrian to share his views on this.
Yep, thank you, Chiman. Yes, so when we talk about old economy, definitely we want to look at some of the old bellwether indicators that we used to, and when we used to track in terms of Asia, and most of the time we always we look at the HSI index and how HSI is performing, and then back in the past where we always take the lead for HSI in terms of Asia stock market performance going forward. So what we do is actually right now. Hong Kong has actually been given a new role, expanded role to play in the China's 14th five-year plan. So back then, the 12-year five-year plan, the 13th five-year plan, they play about 7 roles for China government in terms of, asset management, financial center, being an international financial center, a trade center for China as well. But in this new 14th five-year plan, Chinese government has actually given Hong Kong economy and a new expanded role, and that's where they will actually be included into development of the Greater Bay Area, integration into the national development, things like that. So their role is expanded twice. Back then it was only about 7 roles, but now it's about 14 roles that they have to play. So they play an expanded role right now for the 14th five-year plan. So that's going to be a supporting factor for the next 5 years. Can I have next slide, please? And breaking down into the new 5-year plan is a new stage for Hong Kong to perform. And having said that, they would, with all this in terms of different, like say for example, financial sector, right, financial services, some of the key teams and the key catalysts linked to the 14th five-year plans that Hong Kong would probably be a place where it would be a center for green financing. So it probably about ESG. And you're talking about the wealth connect going forward as well. So Hong Kong has a more role to play in terms of that. A financing center for technology and innovation. So things like that. And all this will actually take up about 6.8% of employment for Hong Kong. And for Hong Kong GDP is about 20% due to financial services. Can I have the next slide, please? And having said that, some of the things like offshore, for example, like international in technology innovation center, as well for Hong Kong, and that's where the cooperation for the Greater Bay access. So this again, will continue to contribute to the new stage that a new role that Hong Kong will play for the 14th five-year plan. Can I have the next slide, please? And having said that, you could see with a new roles, with a new stage, they have a new role to play. You could see that southbound trading volume has actually gone up by about 16% for the last 3 months for the last year on year for Hong Kong. And Hong Kong has actually been acting as the offshore renminbi deposit, and you could see that actually that deposit rate has also grown pretty well since 2016 as well. And just want to take note on why the Greater Bay project, right, which is called the Guangdong, Hong Kong, and the Macau Greater Bay Area project, right? How it will help Hong Kong is actually due to the GDP growth, right? With the GBA, and is actually much larger than Hong Kong itself. So we believe that by this, the Hong Kong will stand to benefit from this project going forward for the next 5 years. So just as of how Hong Kong companies, most are actually some are actually head shares or like Chinese company listed on Hong Kong Stock Exchange. Fundamentally, underlying the assets is still denominated in renminbi, and we did the research as well. Our quant did the research as well. If we felt that it has the same relationship as how the FTSE China A50 index has with the strength of the renminbi as well. And you could see the performance is actually very, very similar to the HSI performance versus the renminbi is actually very similar to the FTSE China A50 as well. So again, I believe with the new stage right now that Hong Kong is playing for China, and also looking with the strength of the renminbi continue to be a price support for HSI going forward as well. Can I have the next slide, please? So again, today, likewise, the HSI has actually rallied about 500 points today, and looking at the average PE right now, for the index is about 12 to 13 PE right now. So it's still actually off the average high, and we feel that it's just it's still a very good kind of valuation to enter into the Hang Seng or the Hong Kong economy right now. The next slide, please. And likewise, so HSI has also a huge component into financials, and if you have a more diversified view of the financial and Hong Kong, you can actually invest into the HSI as well.
Yeah. Adrian, interrupt you a bit. You guys have another ETF which is tracking the HSI closely, right?
Yes.
Yeah, so I think so for the benefit of the audience, if you'd like to check it out, the HSI ETF is the ticker code is 3037. All right, 3037. You guys can check it out on your brokerage account. Right, let's move on.
Yep. So again, HSI dividend, HSI on the index, right, give out an average yield about 2.4%, and it's actually forecast again, at the end of the year, it will actually spike up to 2.8 dividend yield, and it's actually forecast in 2022 the yield is actually very close to about 3.2% going forward as well. So again, just like the FTSE China 50, a strong renminbi for appreciation of the assets, capital gains, and also provide some form of dividend yield play as well. Yep.
All right. I think before we move on to the Q&A, right? So I think both Chiman and Adrian has presented a very comprehensive and informative webinar thus far. I had some problems trying to catch the fine little details and all the numbers, right? So if you forget anything, this actually the three key takeaways that you might want to look at, right?
Yes. So I think one, for example, a very good clear example is that actually China leads the way in terms of global recovery right now. In fact, it's actually going through a level of sustained growth, while the rest of the world is still facing second wave, third wave, kind of thing. For example, I just heard from a friend from Australia that they are going through again another kind of like a mini lockdown again. They have to wear masks. The world is still trying to get the act together in terms of controlling this pandemic. We also did mention about the sector rotation is there. There are actually money is flowing into lower valuation yet a very strong balance sheet, high profitability kind of companies, low PE, low valuation, due to the fact that there might be a risk of inflations, and also central banks tightening their policies, and taking out liquidity from the market. If such thing happens, usually the low valuation sectors will definitely have a competitive advantage versus the growth stock. And if we believe that sector leaders, established banks and established insurance and brokers would definitely stand to gain more from this recovery. So FTSE China A50 and Hang Seng Index itself tracks majority into the financials, and usually most of these are financial leaders as well. So besides capital gains, riding on to the strong policies from the government, these two indices also provides very strong dividends, and very strong dividends growth is actually being projected as well. So these are my key points. Thank you.
Thanks, Adrian, for sharing. So I think we are out in the Q&A, right? So we got a couple of questions here. Let me take some questions, right? Let me take some questions. Okay. Right. Right. Okay. So I think there's actually a question to ask. Yeah, is there a H share ETF to buy rather than the China A50 ETF? Adrian, maybe you want to take this question?
Yes. Is there a H shares rather than no? Right now we do not offer that as well. Sorry about that.
Okay, sure. Oh, guys, come on, come. Add the questions, please. We're still waiting for more questions. Okay. Okay, maybe I got a question for you guys, right? So I think we have seen this sector rotation, not just in China and Hong Kong, but I think in Singapore and in US as well. So I think, do you guys feel that, the rest of the world might be fundamentally different from China, given that the government is having a lot of control in China over, like, let's say there's this policy risk that Chima actually brought up. So do you guys think that this one would have a spillover effect in any way to maybe, let's say, Asia? I mean, Singapore, Southeast Asia. I mean, yeah.
Maybe I think it is a quite interesting and quite interesting question. Is because in fact there may be a so-called a mirror, I would say, because so far, in particular, why the China export is so strong is because in other countries, they are under lockdown. That means their manufacturing sector cannot run at full capacity, or maybe even a very low utilization rate. So that's why right now it's quite interesting. That means if we really see, maybe because of vaccination or for other reasons, if we see the COVID-19 cases in other countries coming down, basically, I don't rule out the possibility that those, for example, like in Southeast Asia, they may outperform if their COVID-19 cases really coming down, because that means their manufacturing sector will resume production gradually. That may reduce their reliance on Chinese exports, because right now many people need to place order to Chinese manufacturers because their domestic capacity was affected by COVID-19. So I think we need to pay attention. I don't rule out maybe in the second half of this year to maybe at a certain point of time, there may be a switching opportunity between China and Southeast Asia. If we really see the Southeast Asia manufacturing sector can resume production because of the improvement in COVID-19 situation.
I think a very good point, because I think like you and Adrian mentioned earlier, I think China is taking the lead in recovery. So they have recovered so fast until the rest of the world is trying to battle waves, and here they are doing such a drastic recovery in terms of the economy, in terms of getting things up, and in terms of, I think, probably vaccinations as well, right? So thanks for answering that question. Right. So, okay, there's another question by Mr. James Ho, right? What is the forecast for Hong Kong dollar, and what are the key factors that will affect its appreciation or depreciation going forward? Adrian and Chiman, you guys, any of you like to answer? Hong Kong dollar appreciation or depreciation?
I think, frankly speaking, because of the linked exchange rate or so-called peg exchange rate system. So basically, there is no so-called appreciation or depreciation of Hong Kong dollar, because basically, it directly linked to the US dollar. So I think what we really need to see is whether the US dollar itself will appreciate or depreciate. But it's quite tricky because we see both positive and negative for US dollar at the moment. So for the negative, people talking about, for example, right now they are talking about those 2 trillion or even sometimes more of stimulus package for infrastructure and some other things. So some people expect there may be some depreciation pressure, but at the same time, compare with other developed countries, the US economy actually we recover quite well because of the quite okay vaccination progress. So I currently don't expect a sharp depreciation or sharp appreciation of the US dollar in the near term, given that we see both positive and negative at the moment. So but if you ask me about renminbi, in the near term, probably renminbi will still be quite strong, given that their export perform quite well. Unless maybe, as I just mentioned, maybe in the later half of this year, when we see the recovery of other economies, especially the emerging markets, then we may see some weakness of renminbi, but probably not in the next maybe 2 to 3 months, quite unlikely. So I will say for renminbi in the next few months, I'm positive, but for Hong Kong dollar, because it is linked with the US dollar, I think maybe we can't say whether it is appreciate or depreciate for Hong Kong dollar.
Thank you, Chiman, for answering that question. So another question is, of all the, asked by Mr. Alvin, right? So of all the 4 Chinese banks, which is the preferred bank, in terms of share price appreciation, I would assume?
I think in terms of fundamentals, if we're talking about the big 4 banks, China Construction Bank and ICBC, these 2 are always the better ones. Because BOC and Agricultural Bank have their own issues. And therefore, in terms of balance sheets, CCB and ICBC always the better one. And that's why we will stick with these 2 rather than BOC and Agricultural Bank.
Thank you for answering that question. Right. So we have time for one more question, right? So Mr. Anonymous Attendee is actually asking, what is your top 3 high dividend stocks under the house view, at least? Yeah. Top 3 high dividend stocks.
I think, in fact, both CCB and ICBC right now, the dividend yield, both are quite decent. And for the others, if you're talking about pure Hong Kong play, the absolute dividend yield definitely is not as high as those Chinese banks, but compared with other Hong Kong equities, still quite okay. I will say Link REIT, 823.HK. The dividend yield may be around 4%. Why I think people may look at it is because we see the COVID-19 cases in Hong Kong is stabilizing. So we will expect a gradual reopening of the Hong Kong economy. And because Link REIT, their shopping malls are focusing on domestic consumption rather than the tourists. So that means they will benefit faster than other shopping malls, because some of the major shopping malls in Hong Kong may focus more on tourists. But for Link REIT, they focus more on domestic consumption. So I think if you're looking for dividend yield, you may also looking for Link REIT, although the yield may not be as high as the Chinese banks, but when you compare with other Hong Kong equities, 4% is still quite decent or quite okay, I would say.
Thank you, Chiman, for sharing. So I think we're a bit short on time right now. So before you guys go, I'd like to share something, right? Which is we're working with CGS CIMB to actually have this special promo. So basically what it means is that if you buy 5,000 units of ETF, you get 5 free. All right. So this promo, it's a shout out to CGS CIMB for doing this from 1st April to 30th June, right? So if you guys are interested, do take out your handphone and just do a quick scan on that, right? So all the details are there. Do check them out. All right. So for ETF related inquiries, please do drop Adrian here an email at his email address. And for any account related inquiries, do drop it to Nixon. All right. So two distinguished gentlemen, thank you so much for your time in presenting this comprehensive webinar. So we didn't even have any breaks for this. So thank you so much for your time, and we're a bit short on time. So thank you everybody for joining this webinar this evening. Right. So this webinar will be recorded. We'll post it up on YouTube. Do check it out if you want to rewatch it. All right. So we'll call it a night, and thanks everybody, and we'll see you in the next one. All right.
Good evening. Thank you so much. Thank you.
Thank you. Bye-bye.
Thank you very much. Good night.
Bye.